Hello and welcome to this Commerzbank webcast. At client events I'm often asked who is to blame for low bond yields. This makes me realize that many clients believe in the story of a global savings glut. According to this theory, the savings have increased globally, for example because of the current account surplus of emerging markets or because globally the share of working age population has risen and this segment saves more than pensioners. The increase in savings is then meeting with insufficient profitable investment projects. The surplus in savings is pushing down interest rates. This sounds plausible on the surface, but I'm not convinced. Firstly, the current account surpluses and hence the savings of emerging markets have risen sharply after the Asian crisis in 1997-98. These savings were mainly invested in US Treasuries, which lowered their yields. However, the current account surpluses of emerging markets have fallen since 2007, which contradicts with the theory of the savings glut. Secondly, the rising share of the population at a working age and therefore at a savings age does not only increase the supply of capital, but also the demand for capital. Indeed, for every new job, offices, machines and computers are needed. It is therefore questionable whether the shift in age structure in favor of the working population leads on balance to a savings surplus and hence lower yields. The theory of the savings glut is not enough. To explain the current low interest rates, we mustn't ignore central banks. They have markedly increased their share in outstanding government bonds. This explains the fall in yields the past years and not the savings glut. But this also means that once the Fed exits from the expansionary monetary policy, yields will also pick up somewhat. Thanks very much for watching and enjoy reading our Week in Focus.